A piece of your next paycheck could soon buy a company you cannot look up, cannot price every day, and may never know by name. Not because you chose that company, because private equity is being invited inside the funds that sit in ordinary 401k plans. The sales pitch is simple. Wealthy investors and public pensions have had access to private markets for years, so workers should get the same opportunity. The awkward question is whether this opens an investment opportunity for you or a $9 trillion distribution channel for them. And the answer is not that private equity is automatically good or automatically bad. The real answer lives inside the plumbing. Who chooses the fund, how the assets are valued, how easily money can leave, and what reaches your account after every layer has been paid. So, let us follow $1. Start with scale. More than 90 million Americans participate in employer-sponsored defined contribution plans, and 401k plans alone held about $9 trillion at the end of 2024. That is not one investor making one decision. It is a river of payroll deductions arriving every week in good markets and bad ones. Most of that money has traditionally reached public stocks and bonds through familiar funds. Private market firms operate behind a different wall. Their companies do not trade continuously on an exchange, their loans are privately negotiated, and their funds often hold assets for years. What they need is patient capital. Retirement money is almost designed to look patient. That is the first reason private equity wants the 401k. The money is enormous, long-term, and replenished automatically. Access does not prove that workers will be exploited, but it does explain why the industry has a commercial reason to call this democratization. The door began moving in August 2025 when the White House ordered regulators to broaden access to alternative assets in workplace retirement plans. Then, on March 30th, 2026, the Department of Labor proposed the machinery that could make plan sponsors more comfortable using them. It is still a proposed rule. It does not force your employer to buy private equity, and it does not place private assets in every account. Instead, it offers plan fiduciaries a process-based safe harbor if they properly examine 6 things: performance, fees, liquidity, valuation, benchmarks, and complexity. That matters because the department says plans technically had room to consider alternatives before, but almost none did. Litigation risk and regulatory uncertainty made committees cautious. The proposal is meant to reduce that fear, and the category is wider than private equity. It includes private debt, real estate, infrastructure, commodities, some digital asset vehicles, and lifetime income strategies. The crucial detail is how the new assets are likely to arrive. You may not see a button marked, "Buy this private company." The route described by regulators is an asset allocation fund that contains a private assets sleeve, the sort of bundled product a worker could own without selecting the underlying holdings one by one. Here is the journey. Your dollar leaves payroll and enters the employer's plan. The plan places it in the fund you selected, or the default chosen for you. That fund can place a limited slice into a pooled vehicle. The pooled vehicle then commits money to private equity funds, private credit funds, property, or infrastructure. From the worker's side, the account still needs to behave like a retirement account. People change jobs, rebalance, borrow from plans, retire, or make hardship withdrawals. But underneath, some assets may trade only occasionally and return cash on their own timetable. One layer wants daily usability. The other is valuable partly because it is not daily. The wrapper is supposed to reconcile those two clocks. It can hold liquid public assets and cash around an illiquid private sleeve. It can limit the private allocation. It can stagger commitments and redemptions. Done well, the worker gets diversification without having to negotiate a 10-year fund contract. Done badly, the wrapper promises an easy exit from assets that do not have one. The same layered structure also makes costs harder to read. There can be a plan layer, an asset allocation layer, a private market vehicle, and underlying managers. The exact stack will vary by product, but every extra layer must justify itself, because the worker owns the return only after the costs. Now look at the same journey from the private market side. A new retirement product creates access to millions of small savers without asking those savers to qualify as wealthy investors or wire money into a private fund themselves. The plan and fund wrapper do the aggregating. That can broaden the buyer base for private assets and give managers another source of capital at a time when selling companies and returning cash has sometimes been difficult. Wharton researchers make the point carefully. When exits are challenging and continuation funds are more common, unsophisticated plan members could pay large fees without receiving superior returns. Could, not must. There is another incentive built into valuation. Private assets do not come with a fresh market price every second. Their values are estimated through models and periodic transactions. The SEC's Investor Advisory Committee warned that impartial valuation matters, especially when fees are charged using the value of assets. A higher estimate can affect more than the picture on your statement. None of that proves the product is a trap. It tells us why access is the wrong final test. Private market firms gain assets to manage, products to distribute, and fees to earn. Workers must gain enough net return or risk reduction to make that bargain worth it. So give the strongest case for saying yes. More economic activity now happens outside public markets. Long-term savers may be able to tolerate some illiquidity, and assets that behave differently from listed shares and bonds can improve diversification. Public pension plans have used private markets for years for exactly those reasons. BlackRock has modeled what a 10 to 20% allocation to private equity and private credit might do inside target date strategies. Using its own forward-looking assumptions, it estimates roughly 0.5 percentage point of extra annual return and a 15% higher ending balance. Those are projections, not observed results, and BlackRock explicitly says there is no guarantee. Wharton researchers also argue that the risks can be managed through professional oversight, multi-manager funds, careful plan design, and target date structures. That is much more credible than handing every worker a catalog of opaque funds and calling it freedom. The useful version of access is curated, limited, and boring. In other words, private assets can belong in a retirement portfolio, but only if the structure earns its complexity. The fact that wealthy people own something is not, by itself, a reason to place it inside everybody else's default fund. The Department of Labor's 6-factor checklist is almost a map of every place the machine can break. Performance can disappoint. Fees can absorb the advantage. Liquidity can vanish at the wrong moment. Valuations can be stale or conflicted. Benchmarks can flatter the product, and complexity can exceed the skill of the people selecting it. Valuation is the quietest problem. Public shares give you a market price, imperfect but visible. A private holding may be valued quarterly using assumptions. If people enter or leave a pooled fund at an estimate that is too high or too low, value can move between the people trading and the people who remain. Liquidity is the loud version of the same mismatch. The Financial Economists Roundtable warns that an open-ended fund holding hard-to-sell private assets can face dilution or even a run if too many investors want cash. That does not make failure inevitable. It means the exit design is part of the investment, not paperwork around it. Manager selection matters too. Private market outcomes depend heavily on access, expertise, and the price paid. More demand from newly eligible money can also push asset prices higher, shrinking the very illiquidity premium used to sell the idea. Great past funds do not arrive in a default plan by magic. And then there are fees. Government research has repeatedly warned that even seemingly small annual charges can materially reduce a 401k balance over time. A private market allocation does not need to be cheap. It needs to beat the cheaper alternative after every charge and after adjusting for the extra risk. So, who gets rich? The honest answer is the manager gets paid for managing the product. The worker benefits only if the product produces enough extra return or stability to beat its fees, its valuation uncertainty, and its liquidity limits. Those two outcomes can happen together. They do not happen automatically. If these funds reach your plan, the useful questions are already sitting inside the proposed rule. What is the total cost? How much is actually private? Who values it? How can the fund meet withdrawals? What is the honest benchmark? And does the plan committee understand what it bought? That is why this is not a referendum on private equity. It is a referendum on product design and governance. A small, professionally selected sleeve may help. A high-fee, hard-to-value allocation placed inside a default fund because the industry needed new buyers may not. Private equity wants your 401k because $9 trillion is a market too large to ignore. Whether you should want private equity back depends on what survives the journey, not the headline return, your return. If your employer quietly added private assets to the fund you already own, would you want a vote? Or would you trust the committee to choose? Tell me below. And subscribe if you want more money systems followed all the way back to the person paying for them.